Hello everyone, welcome to our webinar. My name is Steven Reiter. I'm responsible for the options business here at AvaTrade, and I'm going to take you through the advanced features of our AvaOptions app and Webtrader. We're going to get started in just 1 minute, so just bear with us because we have a lot of people registered for today's webinar. We want to make sure they have a chance to log in. So just another minute and we'll get started. Okay, let's get started. My name is Steven Reiter. As I mentioned, I'm responsible for the options business here at AvaTrade. We've developed this trading platform in-house. We think it's terrific and we want to show you how to use it and show off some of its advanced features. On the screen you see now is our WebTrader. I've logged in by logging into the Ava website and then clicking on Web Trading next to my options account. That will automatically launch this WebTrader in a new window, and I've expanded it to the full screen. On the left side, you see a list of instruments. This is similar to most trading platforms. You can use this orange button to choose specific sets of instruments, like energy. We only have crude there, majors, everything. And you can also select favorites by choosing them with these stars. Anything with a star becomes a favorite. And then I go here and I go to favorites, and it's only showing me those that I've put an asterisk next to. In the center of the screen is the chart. The chart is where we do all of our work. This interface is purely chart-based trading, and I'll show you what I mean. Let's say I'm interested in trading euro against the dollar. Here is my default chart. I'm currently actually on a 1 hour chart. You can look at 1 minute bars, 30-minute bars, etc. We're only looking at trading FX here, just regular spot buying and selling FX or a CFD. And you know that because right here in the strategy button where my mouse is, you can see spot is our strategy. If I click that button, that's our strategy button, I can select option strategies as well. But first, let's just look at regular spot trading so you understand how this interface works. And by the way, I can see your questions. If anyone wants to type in a question, ask anything along the way, I'll do my best to get to you, but we have already a few hundred people logged in, which is amazing. So I will do my best to get to all the questions along the way. So here's a chart of spot. This is 30-minute bars. Down in the bottom, you can see in the crosshair, you can see the dates of the different candles. We can also change the type of a chart. You can have a bar chart. You can have Heikin-Ashi. Ooh, what happened to my Heikin-Ashi? Well, Heikin-Ashi disappeared for a moment. Let's go back to the bar chart or candles. I can add also indicators like moving averages. I can choose my colors. This is a simple moving average. You get a nice pink line. And I can also annotate and do all sorts of things on my chart. On the right side of the chart, I have my P&L diagram, and this is all responsive. This basically shows that if I buy euro-dollar, if I buy 100,000 euro-dollar, the market goes up, I'll be making profits in green. If the market goes down, I'll have losses. This is regular FX or spot trading. It means profits on the way up, losses on the way down. If I go short the market, I have profits on the way down and losses on the way up. And let's say I go long the market and I decide to put in a take profit. I simply use the chart. I want to put in a closing take profit. I just click on this arc on the closing line, and here's a stop loss. And I use my mouse to very simply set the take profit or the stop loss. I can double click and set a specific exact rate, like 109 take profit, and maybe a 105.80 for the stop loss. And if I buy at the current market, 107.41, and I reach my take profit at 109, my profit on 100,000 will be $1,589. And if I hit my stop loss, my loss will be $1,600. So you can see very clearly exactly what's going on, what my risk is, purely chart-based trading. If I go short the market, then that upper bound is going to be a stop loss and the lower bound will be a take profit. If I want to execute this trade, I just click again and click execute and my trade is done. And you see it's popped into my open positions. I've sold cash and I have in blue waiting, it's kind of cool blue, we have both a take profit and a stop loss. On the in this execution panel, it shows me what my available margin was, what additional margin is needed for this trade, how much interest is earned on this trade, if there is any, and what my bid-ask spread would be. So I can close that, and let's move on. Now let's say we want to trade an option, something more interesting. The problem with spot or FX or CFD trading is that you have only one choice, to buy or to sell. And you can limit your profits and losses and limit your risk by using take profit and stop loss. But we have another way to trade, which is using options. Options give you asymmetric payoff. Let's look at a call option. A call option gives you the right, but not the obligation, to buy an asset at a specific price on a specific date. So here's a call option on Eurodollar. I choose my expiration date right here. I can choose any expiration date from 1 day to 1 year. Let's say I choose a 1 month option. And I choose my strike with this handle. I just use my mouse to set the strike of the option. So if I set my strike here, the market's trading at 107.45. Let's say I buy an option. I have the right to buy Eurodollar at 107.50. It's going to cost me 107 pips. You can see it here, 107 pips. On $100,000, I click this white box in the middle. I'm going to be paying $1,074 for the right to buy 100,000 euros at 107.50 in a month. You can see that the most I can lose in this P&L diagram is what I paid for the option. That's in red. My profit is unlimited. So this is the beauty of options. You have asymmetric payoffs. The most I can lose is what I paid for the option, and the most I can profit, of course, is unlimited. I also can short the option. If I go short an option, if the market does not go up, I'm going to keep all this premium. I'm going to earn $1,000, and I'm like an insurance company. I'm providing somebody else with cover, with risk. I'm giving them the chance to hedge their risk. This is a beautiful thing about options trading. Same thing with limit orders. I can put in a take profit and a stop loss. And you can see that the take profit and stop loss is based on the price of the option. I'll put this back in price. I'm going to buy this option for 107 pips, 0.0107, and I'll put in a take profit at, let's say, 3.5 points. And I'll put in a stop loss at 100 pips. Not 100 pips, let's put it in at 50 pips. Okay, so you see here the orange line is showing us our P&L today. If the market doesn't move, I'm only going to lose today my bid-ask spread. As the market goes up, I'm going to participate. And as the market drops, I'm going to start to lose according to the delta of the option. And I can use my horizon line to see how the orange line, how the profit changes over time, or how the valuation of the option changes over time. Let's get rid of the limit orders, so simply look at it this way. Today, if I buy this option and then immediately sell it, I'm going to suffer my bid-ask spread, which is 7 pips. So you see the bid-ask spread, $70 on 100,000, that's 7 pips. And over time, I'm going to approach that red and green. At expiration, either the option will be out of the money or in the money, and you'll see how your option will profit or lose. Again, I can just click to execute. The trade is done, and it shows up in my open positions. I just bought a call on 100,000 at 107.50. I'm being asked if we can trade options on US indices. We expect to be live with options on the US 500 or the S&P 500 in the next few weeks. And after that, we'll be adding options on the NASDAQ and FTSE and other things as well. Someone is asking, the lose on options is less. When you buy an option, the most you can lose is what you paid for it. If you want to make this option cheaper, you can set the strike higher. Instead of the right to buy at 107.50, which costs 107 pips, I can set the right to buy at 109. It's further away. It costs half as much, or less than half as much. So now I'm only risking $460. I can even go further away. So the price of an option depends on the strike. It depends, of course, on time, and it depends on the volatility of the asset. Let's look, for example, at gold. An option on gold is going to be much more expensive. Same option on gold for a month is going to cost about $27. The volatility is 13%. Compared to Eurodollar, the volatility was around 8%. So options on gold are more expensive, and we can do all sorts of strategies, buy an option, sell an option. Again, we have limit orders. We can put in an entry limit order that says I want to buy the option. Instead of paying the current price is $27, maybe I want to buy it. I'm only willing to pay $20 for this option. So I put in a limit order to buy the option for $20. Today, that should happen if spot drops to about $18.54. Spot's got to drop about $15 in order to fill that order. And then I can put in a take profit above. Let's say I'm going to buy it for 20, and then I'm willing to sell it for 80. I'll make 4 times my money if both of these things happen. And in order for them to happen, spot today should drop to about 18.53 to get into the position, and then it would have to rally back up to about 19.50 before I can get my profit. So click buy, execute, and now I've put in a pending order with a contingent take profit. So they're both in blue down in the open positions, as you can see. Different option strategies. We've got things like straddles. Straddle means you're buying a call and a put at the same strike. Let's look at a strangle. A strangle means you're buying a call and a put at different strikes. And as you move your handler, as you change the strike, you can see everything updating. You really get a picture for how you're going to profit from your trade. If I go short a strangle, the nice thing is that I'm selling 2 options. I'm getting paid for 2 options. But in the end of the day, the option, the underlying market can only finish in one place. So I might lose on the call, I might lose on the put, or I might profit on both of them. But at the end, I'm earning 2 premiums, and it's a really nice and very popular trade to sell options and earn income and try to put bounds around the market. We have in the strategy menu, we have a guide. Just click this guide, everything turns blue, and you say, well, what is a strangle? And it explains to you, what is selling a strangle? What is buying a strangle? And you can go through these and understand all of them. A seagull is what we call this 3-leg trade. A butterfly, a condor is 4-leg trade. Click try it, and there you go. With a condor, you're basically buying one strangle and selling a further out of the money strangle. So you have limited loss and limited profit. Now remember, on the left side, if I look at a 2-month option, in the chart, it automatically shows me 2 months of history. In this center section, these gray arcs, it's showing me where the market is expected to head or where it may be at expiration, which is 2 months from now. The 2 white dots at the end of this middle parabola, that's plus and minus 2 standard deviations of movement. So we take the implied volatility from the options prices and we project where the market expects, with what confidence range we can expect for the market. We can say that we're 98% confident that the market will be between these 2 white dots at expiration in 59 days. The central arc is 1 standard deviation, the arc with the white dots is 2 standard deviations, and then the outermost arc is plus and minus 3 standard deviations. So it's just 3 legs, and you can use it to set up your trade exactly how you want. Limited risk, limited upside, limited downside. You can sell it, you can buy it, you can look at your P&L in dollars, you can look at it in price, you can look at it in the price of gold or in points. It's a little clearer if I do a euro-dollar trade. I can see it. Let's actually even better. Let's look at something like Euro-CAD. Here's a Euro-CAD strangle. I have a dollar account, so I can look at my P&L in dollars, or in euros, or in CAD. You can see it any way you like, or in price of the underlying. Typically, I look at the P&L in terms of dollars, and if I grow my trade, I can see how much I can lose on or profit on $4 million of a trade, or in fact, this is 4 million euros of a Euro-CAD trade, or all the way down to the minimum size of 10,000. Someone's asking if we can terminate an option before expiration. All of our options are European style options, which means you can sell your trade anytime. You can open a position now and you can close it at any time all the way up to expiration. You would not exercise it again early. It's not an American style option, but you can open it and you can close it. So for example, let's take one of the positions we just opened. We bought this call. I select it with this check mark. It populates into the chart, and we can see in the chart exactly what trade I have on. I'm long a call expiring in 28 days. If I click execute, I can close it. There, it's gone, it's closed, and it just disappeared from my open positions. You can see it here in closed trades right up there at the top. Sorry, not at the top. The most recent trade is probably this one down at the bottom. It was 107.50 call. I bought it today, I sold it today, I lost $110. Back to my open positions. Let's look at my euro positions. This account has several euro positions. I started out in this strategy by buying spot. I bought spot back in December. You see 2nd of December. I bought spot at 105.27. I'm showing in this open positions a nice profit. I'm running a nice profit because spot has gone from 105 up to 107.43. So I'm running a nice profit today. And I can put in a take profit right now on that position. I can also put in a stop loss to try to lock in my profits like that. I can lock in my profits with a take profit and stop loss versus the current market. I can add that to my current position. But let me show you what I did actually. I'm long spot, and then I bought a put to protect my downside. So by buying a put, now you see I have two positions highlighted. I bought spot and I bought a put. In the window, in this trading window, you can see both positions and what the net P&L looks like. I've protected my downside, so I'm only going to lose maximum of $700, but I'm protecting my downside and I still have all of my upside. And then I did something else to try to profit. I sold a call against it here. And now you can see the combined positions, long cash, long a put, short a call. You can see how I basically locked in lots of profits from that underlying long cash position. And over time, you can see how that P&L is going to be realized. Of course, I can close all the positions anytime I want. Let's look at the risk manager. The risk manager takes all of our positions and aggregates them and shows us our net risk. So we have positions right now in Eurodollar, gold, which is XAU, and Kiwi, NZD, the New Zealand dollar against the US dollar. I have positions in Eurodollar in spot or cash, as well as in options. In gold, I just have a spot position. In Kiwi, I only have a spot position. And you can see my net risk. I'm long, if I'm short euros against the dollar, that means I'm short euros and long the dollar. In Kiwi, I'm long euros and short the dollar. So we aggregate all of our dollar positions into this bar chart. We aggregate all of our euro positions, all of our Kiwi, whatever we might have, and it shows us our net risk. And if I click any of these symbols, I can see all of my positions in that symbol on the chart. So here's Eurodollar, all of my positions together on the chart. Great for risk management, really great to understand what's the net of all the stuff that you've put on, or maybe you want to close some things off. Another position, will I show an example of US 500? Well, we don't have US 500 options live yet. They'll be up here in the next few weeks. US 500, I can simply trade the asset. I'm going to close the open positions right now. Here's US 500. Let's look at an hourly chart. And let's say I want to buy it. You know, the normal, this is just normal trading of spot. I'm going to buy it with a stop loss, execute. And now you'll see that's in our open positions, US 500 with a stop loss. And in my risk manager as well, you can see my exposure from the US 500 as well. In the next webinar, I hope we'll be able to show you examples of options trading with the US 500. It's coming. Okay. We have some great tools in here, such as charting from AutoChartist, signals from AutoChartist. I'm going to click here on the US 500. You see this red, this 7 in a circle next to the symbol. That means we have 7 valid signals which are generated automatically from the price action of the US 500. This is automated chart pattern recognition. And it's showing right now this a breakout pattern that was identified on February 2nd. A bullish pattern was identified based on the daily chart in the S&P 500. If I click it, it gives me a little picture. It's showing what the pattern was, which was a triangle, and it predicts a breakout higher. It's a bullish signal, and it recommends putting in a take profit and a stop loss. I click Apply Pattern, and it puts that pattern right into our chart. So you can see exactly what they're recommending. I just have to shrink the chart a little bit. So you can see it's recommending a take profit and a stop loss. Right at the point of this blue line is when it recommended the trade, which was on February 2nd. And in fact, the market moved a little bit higher. Right now it's on the edge. If we execute this trade, we'll be buying the S&P 500 with a take profit and a stop loss. We can do the same thing in the pound. Let's see if there's a signal there. Nothing interesting. Let's look at Eurodollar, probably similar. Okay, Eurodollar has a falling wedge on an hourly chart breakout. Looks like that. Click Apply the Pattern. It puts it right here into our chart. It's a bullish signal, which so far hasn't proven to be correct. Let's look at dollar yen. We've got a breakout that was identified a couple of days ago on the 4th. Apply the pattern, and that's working. Pattern was identified, market's been moving higher. You can see it right here in the chart. You can remove it from the chart, you can leave it in the chart, you can execute it with the take profit and stop loss that was recommended. I'm being asked if the platform is available for iOS. This platform is available as a web trader on your desktop or laptop. It's also available as a mobile app, a native, beautiful mobile app in both the App Store and in Android, in Google Play. So you can use this on your favorite phones, take it with you. It has exactly the same look and feel and pretty much all the same features. We've got some other advanced features. For those of you who understand implied volatility, the price of an option, as I mentioned, is determined by volatility and time and where is the strike relative to the forward. So let's say we've got a call option. The longer the option, the more expensive it's going to be, but the more volatile the market is, the more expensive it will be. So if I look at my strategy menu, we have something called implied volatility. If I click that, this is really valuable data that's very hard to come by. We get a chart of implied volatility on Eurodollar. So this is for the past 1 year. I'm looking at a chart of 1 month implied volatility. If I go back 3 years, you can see different price, different action. Go back 5 years, you can see what COVID was doing to the world. There's a big spike when everybody got really scared about COVID. And of course, things were very quiet during COVID because interest rates were zero everywhere. And then things started to change. Interest rates started to change differently in one country versus another. You have an energy crisis in Europe and a war causing volatility between European rates and dollar rates. So things have been moving around. And I can compare the implied volatility of Eurodollar against the implied volatility of anything else. So for example, I can do gold. Instead of 3 years, let's just look at 1 year. Gold volatility trades higher than Eurodollar. That's normal. But it looks like the spread between the two of them is changing all the time. And we don't only have to look at implied volatility. We can also look at realized volatility. How volatile has the asset been over the past month? This is 1 month realized volatility. I can also look at the volatility of out of the money options. Let's look at gold puts, for example. 25 delta puts on gold trade at a higher volatility than the at the money, and puts 25 delta calls on gold. I'm going quickly, but this is all being recorded. You can come back and see it another day. Also trade at a higher volatility. And we can see that when I choose gold, where's gold? Gold is here. This little information button, we can see that chart of implied volatility on the right side. Blue is showing us where implied volatility is today. And you can see that a call on the right side, a 10 delta call, trades higher than the at the money, which also is, you can see the 10 delta put is also higher. But volatility today is significantly lower or cheaper than it was a month ago in red. Okay, I'm being asked, what's the name of the software being used? This is the AvaOptions trading platform. You can go into the App Store or Google Play and look for AvaOptions, or you go to the AvaTrade website and sign up for an AvaOptions trading account, and then you can use this web trader. And of course, you can use it for FX and options. In terms of margin, you should know that we do span margining. So all margin is calculated on a portfolio basis. We take all of your calls and puts and spot positions in each asset. We stress the market. So if a margin is 1%, then we move spot up and down 1%. We move implied volatility up and down, and we figure out how much risk is on, and that's how we determine the margin. If you're a EU customer, leverage in options is 100 to 1, whereas leverage in spot is regulated by ESMA at 30 to 1. So you've got basically triple leverage when you're using options as opposed to using spot. The same thing is true in Australia. In other places, we give the same leverage for spot and options. And you can see that leverage right here on the right side of the screen. If we go to Eurodollar again, market, you have the trading info or market info. You can see here on the right side, the lot size, the options leverage, overnight interest, etc. Okay, so it's 100 to 1 leverage in this account in spot and options for Eurodollar. Okay, over in the side menu, we have video tutorials. Just click video tutorials. You get a whole menu here of webinars and tutorials that are available in YouTube. You can watch them right here in a window inside the app, or you can go and watch them somewhere else. But we've got a full suite of tutorials. This is a picture here of the WebTrader. I'll just show you, sorry, of the mobile app. You can see the mobile app looks just like the WebTrader. Exactly the same interface, same design, same functionality. We also have in the side menu the ability to place deposits into your account. We have trading tools, such as you can see the economic calendar. We have some analytics called Option Quant FX, which will pop up this PDF, this images which will show you some relative value analysis and trade recommendations specifically in options. And I'll just leave it to you to go through and study this. But the basic idea is it's looking for trends in the underlying market, trends or rich, cheap analysis in volatility, rich, cheap analysis or trends in skew, which is the pricing of calls relative to puts, and the correlation of implied volatility and spot to get some idea of how strong these trends are. And then it comes up with various trade recommendations. For example, here in Aussie dollar, it says buy with an exclamation point, which means there's a strong bullish signal in the underlying asset. And because volatility is fair, it recommends going long through a short put spread. So for example, to do that, I'd go here to trade, Aussie dollar, I would choose a put spread, go short the put spread. That is a bullish trade with limited risk, limited upside, and limited downside. This is the recommended way of executing a bullish trade in Aussie dollar, which you see in the orange line. It's a bullish trade. If I execute this trade, you'll see it in our open positions. There's our two Aussie positions. We just bought a put and sold a put. Go to the risk manager. You can see we are now long Aussie. Well, I only did it in 10,000, so it's a small trade. But the net delta is long. I click that. And you can see the position in our open positions. If I want to, let's add to that because I only did a tiny trade. Let's do it again. Aussie put spread. And I'll do this one in, do another 90,000 so that I have a total of 100. Execute. Now I've got more on. My net risk will be 50,000 instead of just 5,000. And I actually managed to choose a different expiration date this time, but this is how it looks. Okay, kind of cool. And so I'm long 50,000. And if I were to, for example, if I was to sell spot against that, if I sell 50,000 spot, then that's going to be a delta hedge. And you'll see that my total delta now has gone to basically 0. And you can see all of the options positions and the spot position here. And now I've totally changed my trade. So this is a pretty cool piece of software. I recommend you use it, play with it, get to know it. It's easy to use once you understand you're trading off of charts. And that's really the best way to trade, to make sure you totally understand the amount of risk, the expected movements in the market, where things can go, how your position will perform. You can trade all of your favorite assets here together, FX, gold, silver. We have the major indices, and we're soon going to have options on the indices as well. Let's just see if there are any other questions. I was asked to keep this presentation down to about 30 to 40 minutes. Someone's asking, what's the ideal minimum amount to start with? Well, first of all, you can start with a demo account. I don't recommend trading with much until you have I wouldn't recommend trading with much until you're really familiar with what you're doing and understand what you're trading. So you can trade demo accounts here very easily. So start with a demo account and then move up with your small deposit. I wouldn't, there's not much point in trading with $100. I think you need at least $1,000 to, or maybe $500 to be able to do much because the minimum trade size is 10,000, an option on 10,000, which really costs very little. Let's look at a Euro-dollar option on 10,000 for a month. Costs $100 if it's at the money. Yep. If it's further out of the money, you can buy an option for $18. So you can buy an option for very little, but you need some money to work with. So I'd go in with at least $500. Being asked about options on stocks. Options on stocks are not currently in scope. Options on stocks are typically, or are American style options. It's just a little more complicated because of corporate actions like dividends and things that get very complicated. But we're going to get started with the equity index options first, and we'll take it from there. Support. I'm being asked, how do I get support when I start? You have, of course, all of our webinars available online. You have on the Ava website an educational section with all sorts of videos for education. We have regular webinars. We do about 2 a month. And you have your favorite customer service representative that you can also reach out to. I'm being asked about trading hours. We are open 24 hours a day, 5 days a week. The FX market basically is continuous. It's closed for just a few minutes as the date changes about midnight GMT each night. So just for a few minutes, trading is not available. And in any case, at that hour, liquidity is very sparse, so it's not a great time to trade. But we're open all the time. You can trade options all the time, buy and sell, open and close, limit orders, whatever you like. We are not, of course, open on weekends. We like to have some time off, and I recommend you have it as well. Okay. I'm being asked to show again a strangle. Here's a strangle, buying a strangle on, let's say, dollar Swiss for a month. 1 month strangle on dollar Swiss. Choose your call strike. If you buy 2 options that are very close to the money or the same strike, that is a straddle. If they're further apart, they are strangles. Right at the money will be the most expensive. Further out is going to get cheaper, but it's all risk and reward. The beauty about this platform is you can look at the screen, simply look at the arc of of possible future outcomes, and just look at the area that's in green and the area that's in red. More risk, it's all a trade-off of risk for reward. It's easiest to see just with a simple call. An at the money option costs 100 pips, you have lots of upside. An out of the money option is very cheap, but the market has to go a long way before you can start to profit. A deep in the money option is very expensive. It starts to look basically like a regular FX trade because your losses are going to grow all the way until you hit that strike, which currently at 0.89 is very far away when the market's trading at 0.92. More than basically 2 standard deviations away, or almost 2 standard deviations away. There's only a 5, if you look at the delta of the option D equals 0.94, that means that there's pretty much a 94% probability that the market will finish higher than this strike at expiration. Whereas an at the money option has a delta of about 50%. That means it's 50-50 chance of being higher or lower than the strike at expiration. Call spreads look like that. Limited upside, limited downside. Risk reversals. A risk reversal is a bit the opposite. A risk reversal, you're going to buy a call and pay for it by selling a put. So you can basically put on a zero cost trade where you won't incur any losses unless the market finishes below this lower strike, but you'll profit. You pay nothing up front, but if you're right and the market heads higher, you can have unlimited profits on the way up. Of course, you can have unlimited losses on the way down, so you have to be careful. And that's why you might want to hedge this risk. The next iteration of this trade, which is the seagull, which looks like this. In the seagull, you have a put down at the bottom to protect your worst case scenario. And again, you can still do this trade for zero cost. Unlimited upside, limited downside, great bullish trade that costs you nothing today and probably doesn't even require much margin. Very little margin. $27 a margin on 10,000 or on 100,000, 270. So pretty efficient trade. I already have an account at AvaTrade. Do I have to open a different account for AvaOptions? Yes, you do. Konstantinos, you have to go into your account when you log into AvaTrade and click to add an account. You'll add an AvaOptions account, and then you'll transfer funds from your existing MT4 or MT5 account, transfer funds or deposit additional funds into your options account. They are separate wallets, separate trade, separate accounts. So you need to open an additional account. Okay, that's all we've got time for. I want to thank everyone for joining us today. Definitely keep an eye out. Watch your emails. We send out information by email. Come here and just play with the platform and use it. Join our webinars. Get in touch with us. We also have in the platform a chat. You can click chat and come in here and ask for support as well. Please keep questions here limited to things about the platform as opposed to your account. Deposits, withdrawals, those sorts of questions should go to your account representative. Go to the AvaTrade website and use chat there. If you have specific questions about options trading, you can use our chat window, and if nobody is answering, you will automatically send us an email. Yes, Gabriel, this webinar has been recorded, and it will be online in the next day. I believe it should be online in the next day. Okay. One last thing I must say, nothing in this presentation is an advice, should be taken as advice about what to do to buy or to sell or whatever else. We are an execution-only platform, an execution-only broker. We give you the power to come into the market, trade options, which is not something you can do very easily with other platforms. We give you a nice, clear, and excellent platform, but it's up to you to decide how you want to trade. The auto chartist signals, for example, are not specific to any user. They're just automatically generated signals from charts that you can use to help guide you in what you'd like to do. And a warm welcome to all those in all over the world who has joined us. And if anyone has joined us from Turkey or northern Syria, I hope you and all your families are well and have survived the earthquake, and all your loved ones have as well. Wishing everyone all the best. Safe trading. Thanks for joining us. See you next time.